Distinction between capital market and money market. The major points of distinction between the two markets are as follows. Participants. The participants in the capital market are financial institutions, banks, corporate entities, foreign investors, and ordinary retail investors from members of the public. Participation in the money market is by and large undertaken by institutional participants such as the RBI, banks, companies, individual investors, although permitted to transact in the secondary money market, do not normally do so. Next one is instrument. The main instruments traded in the capital market are equity shares, debentures, bonds, preference shares, etc. The main instruments traded in the money market are short-term debt instruments such as T-bills, trade bills report, commercial paper, and certificates of deposits. Next, third one is investment outlay. Investment in the capital market, that is securities, does not necessarily require a huge financial outlay. The value of units of securities is generally low, that is rupees 10, rupees 100, and so is the case with the minimum trading lot of shares, which is kept small, that is 5, 50, 100 or so. This helps individuals with the small savings to subscribe to these securities. In the money market, transactions entail huge sums of money as the instruments are quite expensive. Duration. The capital market deals in medium and long-term securities such as equity shares and debentures. Money market instruments have maximum tenure of 1 year and may even be issued for a single day. Next one is liquidity. Capital market securities are considered liquid investments because they are marketable on the stock exchanges. However, a share may not be actively traded. It may not easily find a buyer. Money market instruments, on the other hand, enjoys a higher degree of liquidity as there is formal arrangements for this. The Discount Finance House of India has been established for the specific objective of providing a ready market for money market instruments. Next one is safety. Capital market instruments are riskier both with respect to returns and principal repayment. Issuing companies may fail to perform as per projections and promoters may defraud investors. But the money market is generally much safer with a minimum risk of default. This is due to the shorter duration of investing and also to financial soundness of the issuers, which primarily are the government, banks, and highly rated companies. Expected return. The investment in capital markets generally yield a higher return of the investors than the money markets. The possibility of earning is higher if the securities are held for a longer duration. First, there is the scope of earning capital gains in equity share. Second, in the long run, the prosperity of a company is shared by shareholders by way of high dividends and bonus issues. Next one is primary market. The primary market is also known as the new issues market. It deals with new securities being issued for the first time. The essential function of a primary market is to facilitate the transfer or investable funds from savers to entrepreneurs seeking to establish new enterprises or to expand existing ones through the issue of securities for the first time. The investors in the market are banks, financial institutions, insurance companies, mutual funds, and individuals. A company can raise capital through the primary market in the form of equity shares, preference shares, debentures, loans, and deposits. Funds raised may be for setting up new projects, expansion, diversification, modernization of existing project, mergers and takeovers, etc. So, In the primary market, usually we can see new issues from new company, issues of shares from new company.